here's some quick headlines coming across from Bank of America. The bank saying it paid its former CEO, Ken Lewis, $4.21 million for last year. That included no direct salary, by the way. Direct salary was $0 for Ken Lewis, but he did end up with $4.21 million at the end of the year. Brian Moynihan got $6.5 million from Bank of America as president of the bank's consumer and small business banking unit. By the way, the bank also coming out in this statement on executive compensation, urging shareholders to vote no or to vote against the Say on Pay proposal. Now, let's get back to Harry Rady here, CEO of Rady Asset Management. And Harry, we were talking about the markets. You don't think we're going to see any gains this year. You think we're going to trade flat for the rest of the year. And you think the market's vulnerable. Is it vulnerable to issues beyond Greece, or can that get worse? I mean, what do you think the problems are here?
Well, I mean, the economy is so big and so complex and so many variables play into it. I think the markets just simply run too much too fast, and that it's, in general, it's pricing in almost for certain an economic recovery. And we just see that as inappropriate. That, you know, we've got unemployment continuing to move up. We've got foreclosures, both in the residential market and the commercial market, continuing to increase. We think the Fed's out of ammo. You know, we don't think that there's anything else they can do. And, you know, as we've seen, the market is vulnerable to unexpected shocks, a la Greece. And so, you know, we just think that there's the potential for a double dip, and that the market is clearly not pricing that in.
So when you're shorting stocks that have done well, stocks that are low quality, second and third tier, you told me, and have clearly run too far too fast, you're buying high quality stocks, large cap stocks. What about in the pharma space? I mean, here is an industry that got hit because of concerns about regulation with the new health care bill, and it doesn't seem that it'll be as hard a hit for many of them, but some could maybe get strapped with a higher payment than expected, higher fees than expected.
Yeah, we're a believer that uncertainty and volatility creates opportunity, and that's what exists in the healthcare space. And where we see opportunity is dominant, best-of-breed companies where their stocks are trading at or near their lows, trading at historical low valuations. And the most important factor that we're looking at with these companies is that they have patent-protected portfolios and a robust pipeline. Because we think that the commodity-oriented companies, i.e. the generic drug makers, the healthcare insurers, we think that they could be vulnerable to margin compression, that the government could come in and say, you're going to lower your prices by 20%, or we're going somewhere else.
What are some names, Harry? Some names that investors can sink their teeth into here? Sure.
Some names, you know, we own Endo Pharmaceuticals. Endo Pharmaceuticals is trading at 9 times earnings, growing at 15+%. We love the businesses they're in. We think that their pipeline is underappreciated. Another company in a similar space is Cephalon. Cephalon's trading at 11 times earnings. Historically, Cephalon has traded close to 20 times earnings. And again, we think the market is underappreciating their existing products as well as their pipeline. And last but not least, Myriad Genetics. Myriad Genetics, you know, trading in the low teens multiple, growing at 20–25% sustainably over the long term in this, you know, hot genetic markers and testing space and personalized medicine. So we think any of those companies are unbelievably cheap on their own, and that they are very attractive takeover candidates.
All right, hey, Harry, thanks so much for spending some time with us today. Harry Rady, CEO of Rady Asset Management. That does it, I believe, for this hour of the show.